Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The world of passive funds is still relatively new to the Indian investor. Most people have only just started realizing that there are products that are mirrored on some of the most commonly known indices like the Sensex 30 or the BSE 100 or the Nifty 50. And these funds can take the form of ETFs, exchange-traded funds or index funds. This week, we are going to delve a little deeper and tell you more about different strategies that are available within the passive universe. The whole concept of smart beta, single factor indices, multi-factor indices. What do all of these really mean? And should you be looking at some of these products that are available in the Indian market? My guests on the show are Akash Jain, Associate Director, Global Research and Design at S&P Dow Jones Indices, and also Anil Ghelani, Senior Vice President, DSP Mutual Fund. Gentlemen, thank you so much for joining in. So first things first, Anil, your thought, because DSP as a fund house already has a couple of passive products in the market. I remember talking to you last year about the equal weight index. What is your experience in the Indian market so far?
Very good point. In the Indian market today, as we see, the passive funds are growing very rapidly. So about 5 years back, the total size of passive funds was a very small fraction. Today, as we speak, the total passive funds are in the excess of 1,50,000 crore out of a total size of 25 lakh crores of the mutual fund industry. Awareness is also increasing drastically. So 5 years back, maybe if you go and talk to somebody about an index fund, they will not even relate to it. They will say, okay, index means something like a benchmark or something like a bellwether index like a Sensex, which tracks the economy of the market. Now everybody's aware, it's become a buzzword to talk about passive investing or talk about index funds and ETFs. So I feel still a lot of way to go to enhance the awareness, but most certainly we have come a long way in terms of having investors to look at passive funds in a very serious way.
You gave a large number in terms of total AUM in excess of 1 lakh crores.
1 lakh.
So I'm guessing a lot of that money is because of products like the CPSE ETF or the fact that the EPFO by its mandate is investing in the equity market via the ETF route?
That's absolutely right. So the Nifty and the Sensex ETFs have a lot of allocation coming from the EPFO. So effectively, whether you know it or not, if people like you and me and Akash who are salaried employees, by default, indirectly we have some allocation into a ETF.
Yeah, whether we have actively done it or not. Absolutely. We're already in a passive fund.
We're already in the passive funds. And the other aspect is the government disinvestment. So it started with the CPSE ETF, which was a big success. Then there was a Bharat 20 to the other one. And now, in fact, there is one more ETF which is in the pipeline.
Now, just to keep things very, very simple, I mean, in case you're still new to this, active and passive funds, very simplistically speaking, an active fund will have a fund manager, a human intervention, which is going to be actively selecting stocks, buying stocks, selling stocks. So there's a lot of back and forth that's happening, this churn that's happening. Whereas a passive fund, as the name, why it's called passive, is that it's passive in nature. It simply mirrors an underlying index. And that is where the concept of that underlying index becomes extremely important. Now, Akash, you and your team, I think you've been sort of looking at creating a lot of different indices for the Indian market itself. What is your experience in the Indian market with passive so far?
So let me begin by talking about the SPIVA scorecard, which which is very symptomatic of the market conditions today. So SPIVA is essentially an acronym for S&P indices versus active funds, where we look to compare the performance of funds in 3 categories in India: the large cap, the mid small cap, and the LSS category across different time horizons. This is a biannual report which is actually published in 10 geographies globally. The oldest report comes in the US, which is about 20 years old now.
Okay.
An important data point that strikes out, is that if you were to pick up any SPIVA scorecard over the past 5 years, you would see majority of the large cap funds underperforming over a 5-year period.
Okay.
Yeah. Indices such as the BSE 100 or the Sensex offer you broad market exposure generally. Then there are active factors that the institutional investors have in the past used factors as a tool to construct portfolio strategically or to tilt weights towards known factors. The typical factors you would come across are dividend, value, size, quality, momentum, etc.
You know, I want to hold you there because before even we get into factors, which adds a layer of complexity to a simple plain vanilla index, I think the importance of returns is also very, very crucial to this conversation. Why consider passives, right? At the end of the day, we're all getting into a mutual fund from a return perspective. And what you mentioned about the SPIVA scorecard saying that actually actively managed funds are consistently underperforming. If you could elaborate on that point, what does data throw up?
Sure. So let me highlight some of the factors that are providing tailwinds to passive in India. So I would probably classify them into two sets. One is the factors that have globally affected the growth of passive. First being, I think, the institutionalization of research. As markets have matured over the years, we've seen the institutional share of public equity increasing. So you have more and more institutional investors chasing the same set of stocks to generate alpha. Secondly, the cost. The active managers generally inherently have higher costs because of stock and industry research, management fees, trading fees, etc. So a passive product offers a systematic, transparent, low-cost alternative to investing in markets.
Now we talk about the return. Again, I mean, going back to the point that you made that the scorecard is showing that active funds are not able to really show substantial outperformance compared to passive. So if you could just tell us what those numbers look like.
So if you were to look on I think a 10-year horizon, I have a couple of numbers with me here. I think over a 10-year period, we see that the underperformance of, rather the outperformance of active funds is about 50 bips or so. But if you were to come closer to say 5-year period or 3-year horizon, we do see active funds underperforming.
Anil, your point on this whole sort of tussle between chasing return and whether it makes sense to be in an active fund because it perhaps is supposed to offer you better return.
Oh, well, absolutely. So I think there is no doubt that the concept of active management, I'm not saying it's gone away anywhere. The active fund managers still have a huge potential to outperform the benchmark. There is a lot of process involved in the way in which they analyze company, meet management, decide on whether to underweight or overweight stocks, and hence outperform the index. Having said that, it's becoming increasingly challenging to do that because of some of the reasons that we just spoke about in terms of institutionalization of research, enhanced awareness and information availability. So it's becoming a little bit increasingly difficult, especially I feel in the large cap space.
Okay, so what we're going to do is we'll come back to this whole debate between active and passive towards the end of the show and see sort of what perhaps works best for portfolios. Right now, we need to take a very quick break, but the conversation is going to continue. On the other side, we talk about types of passive investing. As the gentleman already suggested, there's a concept of factors. You can have a single factor, you can have multiple factor. What does all of this mean? We will tell you on the other side.